as air defenses lit up the sky and exploded over Jerusalem.
For the last several minutes, we've seen these flares streaking all across the skies over Jerusalem. And now, for the first time, we're hearing the air raid sirens.
48 hours after Iran attacked Israel with hundreds of drones and missiles, Israel tonight is vowing to strike back. An Israeli official telling NBC News a response could be imminent. While touring a base that was lightly damaged, the only known damage in Israel, the chief of staff of the Israeli army today said,
Iran will face the consequences for its actions. We will choose our response accordingly.
World War III! World War III! World War III! World War III! World War III!
Come on, man.
All right. Today is Monday, the 15th of April. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Apologies for the absence the last couple of days. I was traveling for a medical procedure. That's not what hit me. What hit me is the plane on the way back. Everybody's coughing and sneezing. And oh, by the way, it was a Boeing 737 MAX, so I was surrounded by death. And I caught the flu or the thing or whatever it is, and pretty beat up right now, but we gotta give it a shot. Although because we have to pause for the coughing and the puking and the sneezing, it'll probably take longer to get the video done, so bear with us here, folks. On the other hand, being sick makes your voice sexier, right? No better time to pick up chicks at the bar than when you're sick and you're sneezing and coughing and puking all over the place. And isn't it interesting when the market begins to turn around and we see volatility and the bears wake up from hibernation? That's the time when folks want to watch the Maverick of Wall Street. But the big man upstairs has different plans. Oh, you're excited that the market is going to go down? Well, watch this. I'm going to throw a bunch of diseases on you. I'm going to handicap you. I think the big man upstairs, he bought the dip last week and didn't work out pretty good for him. Maybe that's why he's starting World War III now. Speaking of the big man, not the one upstairs, but the one downstairs. Today's April 15th. AKA Happy Tax Day, baby. You gotta pay Janet. You gotta dig into your pocket and pay the criminals, right? The theft, the greatest theft of all time. You work your ass off the whole year. They take the money and they send it to Ukraine. Can we protest any of that? Can I say, you know what? Not paying taxes this year. I'm pissed off as a taxpayer. You look at healthcare, it's dog shit. You look at the economy, you look at schooling and education, it's in the toilet. So in protest, I'm not going to pay my taxes. Can we do that, folks? In this democracy that we're living in? Or are they going to shove you in jail for a few years to make an example out of you and ruin your life financially? I think the answer is clear. In this democracy that we're living in. And you know what? I just made the check to Zelensky. I didn't even write IRS or the U.S. Treasury. I just wrote Ukraine. Speaking of, somebody's jealous because all of this Israel problem, now they're getting hit, so we have to send them billions and billions of dollars. Somebody's getting jealous, and now he wants more aid and help like Israel.
I want the more money. Give me some more money. Otherwise, you lose your democracy.
You know what else is criminal? It's not just the IRS and Janet Yellen, it's the banks. The banksters, with the high interest rate environment right now, the effective federal funds rate is over 5%. Now, in the old days, your beloved banksters, if you have an account, savings account with their bank, they'll give you the same interest rates as the effective federal funds rate, if not even more. Not anymore, though. People got accustomed that, I'm going to just shove my money in a savings account and I get nothing for it because interest rates are zero. What if I told you that you're losing to inflation and it doesn't make sense and you have to stick your money where you can get interest, 5% plus, because the real inflation rate is probably 8 to 9%. See, if all Americans woke up to this fact that, wait a minute, we're getting robbed here. My savings account is not paying me anything. I'm taking the money, I'll go. The entire financial system will collapse. This is why they keep you in the dark about this fact. But now, after the earnings from JP Morgan and their interest income was guided down, now JP Morgan is saying, okay, we'll pay you more on your savings because we can afford it. And now the Wall Street Journal asks, will banks finally have to pay you more for your savings? They better, right? They better, otherwise I'm taking my money out. But folks, it was an interesting day in the stock market today. It began with a gap higher. Okay, maybe we're going to recover, and then it got uglier by the hour. And we said that the dynamics in this market are changing. The market is changing its character from buy the dip to sell the rip. There were two predominant themes since the rally began in October, which is, oh, the Fed is going to cut rates, inflation is dead, and the AI mania. The AI mania is not challenged yet until we get the earnings season. But the rate cut optimism, that's gone now. We keep getting hotter data by the day. Inflationary. And the latest is retail sales, up by 0.7% in March, much higher than expected. Now, retail sales is a deceiving number because the propagandists, like the folks at CNBC, see Steve Leisman looking down, he's like, is it finally working? But they were saying all day long, oh, retail sales are hot, that means the economy is great. But retail sales is measuring the amount of dollars spent. And if you have higher prices and inflation, of course it's going to jump higher. It tells you nothing about the health of the consumer. In reality, we are in stagflation. Inflation moving higher, consumer keeps getting weaker. So now the market has one leg, which is the AI mania. But then introduce a headwind such as the geopolitics, which, by the way, we only care about geopolitics because it impacts inflation higher. But you introduce that, and it overshadows the AI tailwind. So let's connect the dots and talk about the geopolitics, because over the weekend, of course, you might have heard by now, we've been anticipating this attack, retaliation by Iran against Israel. And by the way, it's Iran, it's not Iran. You didn't run for shit. I mean, you don't say Israel, right? So why the hell do you say Iran? Although, they might have just made it easier and pronounced it with an E. But that's not my problem. We knew that the attack is coming. It was telegraphed. It was anticipated. We knew that there was retaliation. No surprise here. Here comes the weekend, and we get the news that the Iran Revolutionary Guard seizes a container ship near the Strait of Hormuz amid tensions with Israel. Right off the gate, that was a problem. Why? Because if we continue to see this, you got the Houthis in the Red Sea. Now you got the Iranians in the Strait of Hormuz, and if they keep seizing ships, and if there's any more tension, that strait could be closed. And we're talking about a huge percentage of world oil that comes out of that strait. That's going to be inflationary. So tensions were running high. A few hours later, we got the news that Iran launched, it says here 100 drones. It was actually more than 300 drones and missiles toward Israel. Of course, the majority of these missiles and projectiles were shot down by the Israeli defense system, and of course, our military that's all over the place right now in Syria, in Iraq, in Jordan, in pretty much every place, except the United States, for some reason, to protect us in Jordan. But anyhow, the U.S. military destroyed 80 drones and 6 missiles launched from Iran, Yemen, so we participated in defending Israel from this attack. The consensus would say, oh, maybe Iran would be pissed off. That why did we intervene? And there is this misconception that's been running around that, oh, maybe Iran failed. It was a lame response. The Israelis shot everything down. It wasn't as serious. What is the big deal? It took me 5 minutes to catch the point. What was the point? I mean, think about it this way. They announced the strikes ahead of time. They sent really slow-moving drones that take hours and hours, easy to defend against. They did not send their top military gear or the top missiles. All what they send is the weakest and the oldest in their arsenal. As if the Iranians were intending for this strike, retaliation, to be lame. And as Politico says here, Iran's attack seems like it was designed to fail. What's going on here? On top of that, while the missiles flew over Israeli cities, they never really hit any civilians or any important targets. So CNN says Iran's attack seemed planned to minimize casualties while maximizing spectacle. And then before the missiles even landed, you see the Iranians coming out and they say that the matter can be deemed concluded now. We're done with the retaliation. Should the Israeli regime makes another mistake, Iran's response will be considerably more severe. It is a conflict between Iran and the rogue Israeli regime, from which the U.S. must stay away. Translation: the Iranians did not want to start a war. Not with Israel, not with the U.S., because they know they'll lose that war. And this is why they intentionally telegraphed every move ahead of time and made sure that there's minimal damage, no civilians will die, most of the stuff that they shot will be shot down. They knew all of that ahead of time. So what is the point here? They're sending a message to Israel. Look, you're going to kill our nuclear scientists, you're going to kill our generals and keep attacking us. We're going to attack you in your territory now. We just made a point. But as the Shah of Iran would say,
next time, there'll be no next time.
And that's really it. Next time, there is no next time. They just wanted to make a point that we can reach you, and next time, it's going to get ugly. So let's cool it off here. Here's the problem, though. It brings the memories of the assassination of Soleimani under the Trump administration. When you remember how the market reacted at that point. We were anticipating the reaction by Iran. The market was getting hit really hard. Then came the retaliation, a couple of ballistic missiles that hit an American base in Iraq. And of course, they say there were no damages, although later on we find out a lot of soldiers got brain damage, but U.S. Army paid them millions of dollars to shut up. But we dealt with that as, okay, they have to save face, they made a point, there's no major harm done, let it go. And the market actually went higher after that. In this case, though, the market tried to replicate that kind of action. It tried to rally and say, okay, maybe the matter is deemed concluded now, as the Iranians say, and we're not going to see anything else. Big deal. They threatened they're going to do a massive attack, and here it is. It's just expensive fireworks. So let's move on and rally the market higher. Here's the difference, though. Israel is not the U.S. Israel is not going to let it go. More on that in a minute, but immediately the Biden administration came out and said they urge Israel to be careful and strategic regarding the response to Iran attack, adding that the U.S. will not take part in any Israeli retaliatory action against Iran. In other words, the design of this action by Iran was brilliant, whether you like it or not. It sent a message to Israel, but did not cause enough damage to trigger action by the United States. If anything, it triggered action by the U.S. to say, hey, Israel, cool it off. You won. You shot down their rockets. Big deal. Just let it go. We let it go. Let it go. We don't want to be dragged into World War III, especially not before the elections. And we know that we have tensions between Biden and the Israeli PM Netanyahu before all of this happened, because Biden is now losing the polls. And a wider war in the Middle East will certainly cause him the elections. So now we're getting to the phase of a conflict between U.S., Israel, and time is of the essence. And we said repeatedly in this show, you can go back to the first show of the year, we said this is going to be a battle between Biden and Netanyahu. Who's going to tame who? If Biden doesn't exercise his dominance, Netanyahu will assume that he's weak and he's just going to keep going and going as far as he can. Next thing you know, we're in World War III. Which again seems to be inevitable at this point, at least a regional war in the Middle East. And the reason is, Israel is not the U.S. They survived based on the concept of deterrence. It's a small state the size of New Jersey, and they only survived by the concept of deterrence. That if you hit us, we'll hit you 100 times harder, maybe 1,000 times. We're always going to overreact as a deterrence. So to keep that deterrence concept, I don't think that Israel is going to let it go. They're going to respond. Okay, suppose they respond. Where will the attack come from? Will it involve, let's say, Jordanian airspace, Kuwaiti, Saudi? Those parties will be involved now. We're talking about the oil market here. And if Iran is hit, the assumption is they're going to have to hit back. If they hit back and this time around there's damage in Israel, the United States will be dragged into that war. We say right now that we're not going to support any retaliatory action, but if they do it anyways, and then they get hit back, we're going to be involved. There's no doubt about it. And that's what the market caught up to today. That there's going to be a response, and after that response, there's going to be a counter response, and after that, we're going to be dragged into a major regional war. And I said all of this in my thoughts in the tweet last night. You can pause and read it for yourself, but when you combine all of this geopolitical risk, we go number 5. Finally, on the weekly charts, the indices have broken trends and began changing their momentum from bullish to bearish. It is likely that we will enter a phase of sell the rip rather than buy the dip phase that has been dominant since October. Now, here comes the great debate, the oldest debate in the history of the stock market. Is it really the geopolitics? Is it really the macro news? Or is it just the technicals? They're being broken, and that's why the market is going down. But isn't it a real coincidence that every time we have a change in momentum in the market and the technicals begin to break down, we see bad news politically, geopolitically, economically, and otherwise? And when the charts turn from bearish to bullish, as we've seen in late October of last year, all of a sudden the good news come from storage. I'll leave the answer to you. You let me know, because this is the oldest debate in the books. The pure technicians, they would say none of this matters. Fundamentals, geopolitics, nothing matters. The charts were pointing for downside in the equities market, and that's why we're getting it. The folks who believe in fundamentals, they would say, no, it's a combination of both. The geopolitics and the economic news about inflation, that's just triggering the technicals and amplifying them? Again, I'd leave that debate to you folks. But anyhow, let's wrap up our geopolitical coverage and let's move on to the market coverage. Despite my absence last week, I did guide you folks. So April 4th, we said bears are staging the biggest attack on the stock market since the summer of last year. April 7th, we said the sum of all fears. We discussed all of this geopolitical stuff. April 9th, before the CPI, I said you gotta hedge your portfolios. Pre-CPI hedging for cheap. Doesn't cost you a dime. You use some collar strategies. That's selling a covered call, buying a put, especially in your new positions. They go down, and we had a lot of new positions in the portfolio. A lot of them went down, but we didn't lose a dime because we bought those protection puts, the insurance policy, and as these stocks closed below the insurance policy, you exercise and you sell your stock at that desirable price, not the price where you're losing money. April 9th, we said about Jamie Dimon that he's now warning interest rates are going higher, inflation's a problem, this geopolitical stuff, all of this is going to keep inflation higher. And as rates go higher, you lose one of the most important arguments that created this rally in the stock market. And if we look at the contrast between the S&P 500 and commodities for 2024, believe it or not, commodities are winning. That's not what you want to see. If you're talking about inflation is defeated and we're going to cut rates, you don't want to see commodities rallying. And every time commodities take over the performance of the S&P 500, we see trouble. We see the S&P moving down. So when we talk about the weakness in the market and the change of character, we can talk about the introduction of a new headwind, such as the geopolitics. We can talk about the destruction of one of the tailwinds, which is interest rate cuts because inflation is moving higher. We can talk about the technicals too. And April 9th, I said, bears, if you're scared when the weekly charts are looking like this, then you missed on the rally and you'll miss on the corrections too. I don't understand all of this fear when the charts are finally working your way. So at the end of the day, trading the stock market is an alignment of multiple factors. If the technicals are lining up in one way, along with the geopolitics, along with the macro news, then you have to take the chance. And you can't be scared. You have to take the shot. And these charts are from yesterday. I was intending to share with you these charts in last night's video, but we didn't do it, so we're doing it right now. You can look at the updates on your own. But the bottom line is, what led to the stock market rally from a technical perspective alone? How about chips? The chip mania, AI mania. You look at the weekly chart, we have a bearish topping candle, followed by a bear flag consolidation pattern that is breaking down right now. You look at the MACD indicator, it's about to change from bullish to bearish. Okay, if chips go down, you think the market is going to hold? But maybe we have other sectors that could replace the performance of chips, such as the XHB home builders. It's been a contributor to the market rally. That's also showing a lot of weakness. So you see the bearish engulfing candles on the weekly chart. You see the change in momentum in the MACD indicator, just like we've seen back in the summer of last year. Okay, so the home builders weakened and they're correct. What more evidence do you need to see? How about industrials? Would you like to see that? It's been a huge contributor to the market rally, but it's also showing a topping candle followed by a bearish engulfing candle. The RSI is way elevated. The MACD is changing from bullish to bearish, so that's also ready for a correction. Another one, the XLF financials, with JP Morgan crashing on Friday. I mean, you look at this rally week after week with no correction at all, and then all of a sudden it hits all at once. And we have a huge bearish engulfing candle. You see the MACD now changing from bullish to bearish, so even financials are now giving up. So you see the weakness of the market sector by sector, component by component. The XLK, technology, big caps, still holding, but it's about to weaken dramatically because you see the momentum in the MACD. It is changing from bullish to bearish. So when you add all of this evidence, it is leading to a direction, which is the stock market going down. So you have to trust that and follow through. So we talked about the fundamentals, the geopolitics, the technicals. How about the mechanics? You see a lot of folks shorting the VIX. The level of arrogance in this rally has been absolutely stunning. Folks shorting the VIX, selling puts day after day after day. Well, what do you think that's going to do? You introduce a little bit of volatility, and you're going to see huge reactions to the downside via the inverse gamma squeeze phenomenon. And that's how we got volume getting back in 2018. When we look at the sentiment, if the sentiment is too elevated, then is there more room to the upside or more room to the downside when other factors begin to change? Well, if the sentiment is way too extreme to one side, and we know it is extreme to the bullish side, introduce a little bit of bad news consistently, and now you begin to change the sentiment to the downside. And that's exactly what Jamie Dimon said. When I called with the reporters on Friday, Mr. Dimon underlined his angst, describing heady financial markets as, quote, too happy, end quote. He said that he could not predict whether the economy would enter a recession, but that the chance of bad outcomes is higher than people think. And of course, they have to throw cold water on it because this is the New York Times. It's a propaganda machine. I mean, we talked about this before. What is his end game? We're talking about Demon here. You think he's going to make friends talking doom and gloom like this in Wall Street? Of course not. So why is he saying all of these things? Why did he say the same things back in 08 before the crash? And he was proven right. Maybe he's seeing something. But here's the New York Times. They say his gloom, however, has also been consistently at odds with strong financial markets. In late 22, for instance, he predicted economic bumps and potentially a severe recession for the next year. Instead, the American economy boomed in 23. No. It's not the American economy. It's the stock market, because the Fed declared victory prematurely, allowing the cancer to grow back in the body of financial markets and the economy. And now we have to extract that cancer with more aggression. The movie is not over yet. But you got a new generation of investors who, they're in their diapers, really. They have no understanding of market history. And their hero is none other than fraudster Tom Lee. They say, forget about Demon. Demon is doom and gloom. He's a perma bear. You got to listen to Tom Lee. Well, Tom Lee said expect stocks to rally after this week's key inflation report. Whoops. Then said investors should immediately buy the stock market's post-CPI dip, with the June rate cut still on the table. Oh, June now. How's that working out? I think Tom should go back to his original prediction, which was back in January, when he said markets could see a 7% drawdown after this month. Let's get to 7, and then we talk about buy the dip. And before we wrap it up, just in case I'm not able to talk to you again tomorrow, let's do options tracker, because we have important updates and expiration coming really soon. So today we gave you some updates about the Uber trade and ARKK, also the SPY. We'll talk about those in a minute, but here's what we have open. We have MDT, the 87.5 calls, expiration date this Friday. The intention was to buy the stock if it closes above this number by the expiration date. Obviously, looking at the chart, that's not going to happen. There's a 0 chance it will happen. Point being is, instead of spending the money to buy the stock and then losing that position, instead we risked a little bit buying the call options. If it hits, if we close above, we exercise, we own the stock. If it doesn't, no harm done. So that's toast. Then we have service now, 730, 700 puts, expiration date April 19th. Finally, it's beginning to work out. So we have 730 as an important support. You see a big flush candle today because there was an analyst who downgraded service now because it's overvalued. So if we take 730 tomorrow, you probably want to close this trade or roll it to next week if you see more downside to come. Because any rebound, if the stock trades above 730 in the next few days, that trade is probably going to be a loser. But on the weekly chart, you see the formation. Look at the MACD. Momentum is changing from bullish to bearish. You have a bear flag pattern that's now breaking down. You're losing the 20 weeks moving average. Confirmation losing the 730 line. Then you have more downside to come. So if you like it, you need to roll it for a longer expiration date. Then we have Apple, the 170, 165 April puts. Now, you should have closed those when the stock was trading at around 167. Did I close it? Of course not. I was too busy. I couldn't really manage anything here. And of course, they gave us a big pump on Apple last Thursday. They tried to do it today, which amazing that Apple, a $3 trillion company, being treated as a penny stock. But today got whacked. And we might see a miracle here where the trade comes back to life. If it does, we'll look at the chart in a minute. We'll update you, and we're probably going to have to roll it to a longer expiration date. Then we have Coinbase 220, 200 expiration, April 19th, one of the most challenging trades we had so far. And we'll look at the chart in a minute. The reason why I say it was challenging because the stock has been consolidating in a range, just eating time, not making a move. Today it did. In a big way, and the trade is back on track. But we'll look at the chart, and tomorrow's going to be a critical day for this trade right here. If we see another down day, you gotta book it right away. We have no time left. Now let's talk about the ones that we closed today. And I forgot Uber 75.70 puts, expiration date 19th. We had to close this today with a smaller win than I anticipated. Here's the chart, an hourly chart. We bought it in or around the bear flag pattern and it didn't play out until now. But if you look at the chart, the hour size specifically, you can see that it's getting a little oversold, which means that you could see a rebound tomorrow or Wednesday. And any rebound at this point could decay the trade a lot. So it was the wisest decision to close the trade. And if you still like it and you think that we're going to close the gap below, you're probably going to need a longer expiration date. The other one we managed today is ARKK 45 puts, expiration date April 26th. So we still have another week on this one. But look at the daily chart. Can it go down further? I think so. I think it will go down. With yields going higher, sure, it will go down more. But right now, when you have volatility spiking higher today, that's maximizing the value of your puts. When you have a chart that is stretching down the lower Bollinger Bands, the possibility for rebounds are highly likely. And you want to get out of a trade when you're at top. when the volatility is the highest. So when you see the VIX up big as we've seen today, you either book profits or you capture the increase in volatility by selling put spreads on any trade you got. Because if you just let the volatility go higher and enjoy the gains on the original contract, what if volatility goes down tomorrow? Then the contract is going to decay by a lot. And this is why we decided to book the ARKK trade. Now, the SPY 515 500 puts, expiration date this Friday. It is working out as we anticipate. You got the 515, that's in the money, but you also got the 500, which is appreciating in value right now as we see the VIX moving higher. But suppose we get to Wednesday, we see a rebound in the SPY. That 500 contract will lose a lot of value, and it leaves you with the 515 appreciating by more. All in all, the trade becomes profitable, but we have to watch out for one thing. You don't want to see huge rebounds in the SPY. So I would say if we go to 507-ish, 508, you gotta book it and move on. Otherwise, if it sticks in this lower range, 500, 505, that's okay. You let the leg that you sold decay while the leg that you bought appreciate in value. Now, the last one is the Live Nation 100 puts, expiration date this Friday. You look at the hourly chart, double rejection of 102.75, causing a flush down, lost the 100 line today. So far, so good. But it's not profitable enough to book anything here. Now, it is at the risk of a rebound tomorrow. So if you still like it, you probably want to look for a rejection in the rebound and losing the 100 line again. And if that happens, we're probably going to roll it to next week or maybe a little more and double down on it. I still like it, but I think in the short run, it might face a rebound. So keep that in mind. Anyhow, let's add more color to this conversation and move on and cover the market information that we got for you tonight. We begin with the closing of the indices, and here we go. The diamonds in the red by 284.13 points, or a loss of 0.65%. The Nasdaq also in the red, down by 290.07 points, or a loss of 1.79%. The Spider also down by 61.59 points, or a loss of 1.20%. And the small caps Russell 2000 getting absolutely hammered today, down by 2.91 points, or a loss of 1.46%. You look at these sectors, all in the red, led by technology. That's where the profits are coming from. Real estate really yield sensitive, and we've seen bond yields shooting up higher. Real estate gets damaged the most. Healthcare, defensives, those are the safety sectors. If you want to be specific, it's the big pharmaceutical names in healthcare and consumer defensives. It's the staples, the food stocks that you see in the grocery store, not other staples. So it was a defensive theme, even though all sectors were in the red. What's really interesting is, despite the geopolitics and perhaps a spike in oil prices and gold prices, you see materials down, you see energy down. What does that say? There's de-risking across the equities market. We'll look at the contrast between the commodities and the stocks. For example, Brent oil versus XLE. You'll see an interesting phenomenon here. So stay tuned for the charts analysis. What about the breadth? What do we see here? Awful. The NYSE 17% advancing versus 81% declining. The Nasdaq 21% advancing versus 76% declining. Now, when we see the breadth really suppressed like this, you're probably going to get a rebound. Whatever news they're going to throw on it tomorrow, or Israel decided to cool it off a little bit or smoke a bit of hash and decide that they want a piece now. Whatever piece of news, doesn't matter what it is. They give you one, or maybe Jay Powell speaking tomorrow, and we see a little bit of a rebound. Again, the technicals is going to be really important, so stick around for the charts analysis. But heat map, what do we see here? Ugly across the board, and the declines are brutal. For certain names, if you own a stock in your portfolio, it's down 3, 4, 5% in a single day. And this is why hedging is really important at this stage. Is there an interesting theme here? For example, Intel was the only positive name in chips in a sea of red. What's up with that? Maybe it is the value name, government spending, and we still see a catalyst that already corrected. It went down big. So you see the names that already corrected maybe outperforming a little bit today. Another example, if you look at the healthcare sector, you have UNH, United Health, down big after the bad news from Medicare and the hacks and all of that. Today we see it outperforming. It already did the job. It already corrected. Now we see it outperforming. Same goes for, if you look at cyclicals, Nike, beaten, bruised. Now we see it rebounding higher. In staples, we said that folks look at the safety, and safety is in food. So we see General Mills, anything with packaging doing pretty good today. And in metals, really interesting despite the weakness that we see in the economy, the threats, and the rise in the US dollar. Copper continues to rally. I think it's connected with China recovering. The numbers out of China are getting better. So we see FCX Freeport McMoran still outperforming, although the gold miners went negative. Again, stick around for the charts analysis. I got something really interesting to show you. Now, Tesla was, let's say, the notable decliner, down over 5.5% today. When it rains, it pours for the souffle. We got the news that Tesla's cutting the FSD driving subscription pricing in the US and Canada. Now, understand if you own a Tesla, you're sitting on negative equity, the car worth a lot less than what you bought it for, the FSD program, you overpaid for it. At some point, it's going to piss you off. Why did I overpay? Number one. Number two, today we get the news that Tesla is firing 10% of global workforce. Now, this is inevitable as the stock goes down. See, folks say that the stock market is different than the economy. No. The stock market is the economy. How do you think we've averted a recession so far? We should have been in a recession in 23. The only thing that saved the economy is the stock market. If the equity price of companies is moving higher, they have no incentive of cutting employees. So folks have their jobs and they can use the credit cards and the cycle goes on. The moment the stock goes down, in the case of Tesla, at some point you got to do something in reducing your cost and increasing your margins. So you'll see more and more of that. As stocks go down, you'll see more and more unemployment. It's always connected. The stock market is the economy. And of course, this is why they try to manipulate the market to keep the economy afloat. But anyways, this is supposed to be good news, and we talked about it in the morning brief today. Supposed to be good news. That's going to improve the margins of the company. But again, maybe it is the negativity of the entire tape that took Tesla down. Maybe it's going to rebound tomorrow based on that news. Then investors will look at it again and say, wait a minute here. Maybe they're going to improve their margins. Things will get better from this point on. Once again, let's do the charts analysis. But before we do that, let's look at the contrast and the heat map for the ETFs. Right off the gate, we see the TLT down. That means the bond yields are higher. What's going to be sensitive? How about small caps? Down big. The IWM. Real estate IYR down big. Cyclicals like XHB Home Builders, XRT Retail down big. XBI Biotech down big. The KRE Regional Banks, not down big, but down. So what's new here in this tape? Energy lags. That's really interesting. Maybe the dollar is too strong and we see the GDX gold miners now buckling. What's working though? The commodity, GLD, SLV Silver, USO, those are working. Not the stocks though. And of course, the optimism about China, FXI, MCHI, although be it with modest gains today. Let's do commodities. Again, crude oil. The assumption right now is things are cooling off, so we don't need to buy crude. We don't need to do short covering in crude. But boy, if we have an attack by Israel overnight or in the morning or midday, you'll see those spiking significantly higher. I would say as far as 10% for the week, because the assumption will be the closure of the Strait of Hormuz. And that's a big deal. You look at metals. Really interesting, despite the dollar going higher. You see gold positive, silver positive, copper rallying. What's going on here? I think the precious metals, gold and silver, hedge against stagflation, hedge against the geopolitics. It works either way. Copper, I think it's a China-related story, so it has its own tailwinds. We'll look at some softs and grains, negative across the board for most grains like soybeans and wheat. But then we'll look at softs and you see gains once again in what's new, coffee up about 5.5%, but cocoa modest for the day, up a little over 1.25%. But look at rice. We've seen a lot of unusual activities in buying calls on rice futures today, up almost 6.5% for the day. And oh, by the way, butter rallying today by about 5.5%. So if you want to clog your heart, it's going to cost you a little more these days. On to the big casino, the options market. What do we see here? Volume, it cools down when we have down days, because the traders are not accustomed to buying puts or betting on the downside in the market. They're accustomed in chasing the market higher. So when we see upside days, we see huge volumes, buying of calls. But when we have down days, they pull back. Does this have an impact on the market at all, this kind of behavior? Of course it does. This is why we see the new phenomenon of the stock market taking the stairs to the downside and the escalator to the upside these days. It's all about the options market. So if we see traders all of a sudden changing their minds and piling into puts with huge volumes, then we see the escalator to the downside. But for now, we're not seeing that. You still see calls outperforming puts when it comes to the spreads, even though the volumes are down. If we look at the flows, bullish flows, here it is, ZR, that's Rise Futures, 25.5 million almost in bullish flows. And then you look at the super microcomputer and the hourly chart looks pretty good. Maybe it recovers a little bit from the recent declines. Amazon, XLF, but also the VIX. The bearish flows, we see the IWM, LW, huge trade today. Somebody spent over $20 million betting for more downside for Lamb Weston. But the interesting trade came from the IWM. And look at this, highly unusual. Somebody went shopping here, buying puts against the IWM. 220, 223, 219, all in the money. Spending about $11 million. What are they betting on really? They're betting on yields going higher and the small caps index going down because of that. If you look at the unusual activities that took place in the options market today, let's do CCJ Cameco, a stock that I own in my portfolio, but when you see a trade like this, you gotta pay attention. It's a put spread. I think somebody is either betting on the name, against the name, or hedging. They bought the 45, sold the 41. Expiration date, May 17th. You can see the trade right here. Highly unusual. They spent about $1.4 million for this trade. You look at the chart of CCJ. Triple top comes to mind? Sure. Breaking the trend line? Sure. Momentum in the MACD changing from bullish to bearish? Sure. You gotta hedge your portfolio. If you have this name, you gotta hedge. And this trade is a brilliant way to participate in that hedge. Then we have ADI, Analog Devices. Stable stock. It doesn't really move as impulsively as other chips, but this is really interesting. It makes it really interesting because the stock is stable. But somebody's betting for a huge decline here. They bought the 170 puts for the expiration date June 21st. The expectations, the name goes down, loses more than 10.5% of its value by then. Paid about $2.50 a piece, tenor this trade. All in all, spending about $2.5 million. Then we have NUGT Nugget. This is the bullish levered index for gold miners. Not my favorite right now. Stick with the GLD, not the gold miners. But to each his own. Somebody bought the 42 calls for the expiration date May 3rd. The expectations, the name will go higher and gain more than 9.5% by the expiration date. They paid about $1.70 a piece, tenor this trade. All in all, spending about $1.5 million. Last but not least, you got the ticker PLAY, PLAY. This is for Dave and Buster in case you're into food poisoning and pedophilia. But somebody's betting against this name. They bought the 50 puts, expiration date June 21st. The expectations, the name will go down and lose more than 8% of its value by then. Paid about $2.50 a piece, tenor this trade. All in all, spending about $1.5 million. Now, if you look at this trade, this chart, the weekly chart, what do we see here? Lost the 20 weeks moving average. Momentum is changing from bullish to bearish. Is it really surprising if we see the stock heading down to 47.29, which is my next support? So the 50 makes sense here. I think the expiration date is sufficient given it is in the month of June. Let's move on and do some charts and then wrap it up. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? Let's do some catching up because in the last episode, we talked about the possibility of a double bottom in the SPY and they might give us a rebound. Boy, did they give us a rebound. And it crossed above the sloping line of resistance. But again, you gotta trust the market dynamics. Even though we got a fake pump and dump and the Debbie Downers came out, the market is always going to go higher. They're always going to buy the dip. Next day, big shoe, right in the face, big pie, rubbed all over the face, and we see a gap down. Today's the same thing. We see a gap higher and a flush down. The market is changing its character. With that being said, are we oversold right now in the hourly? Absolutely. You look at the RSI, way oversold. Would I be surprised to see a rebound tomorrow? Not at all. Will it happen right off the gate or will it happen after, say, touching 543 as support? I would say if we gap down at 543 or a little below, I'd be inclined to buy some calls betting on a rebound. If we gap higher tomorrow, I'm not sure I'm going to follow it. I'll probably be inclined to fade the rip again. If you look at the SPY daily chart, what do we see here? Let's follow the story. So we talked about the indicators numerous times before, that we're losing momentum. Anyhow, then we got a bear flag pattern. It played out. Then we got a retest at the 20 days moving average. That was met by a rejection. And then what happened? We got support at the 50 days moving average in blue. Today we lost it. So the market is not ready. It hasn't found support yet. Can we speculate on the next support? Yes, we can. How about the gap? In or around 497.37. How about the SPX, the cash index daily chart? We've broken trend. You gotta trust these things, folks. We've been pointing these kind of patterns for days now. We broke the pattern, the trend line. You gotta trust it. Retested the trend line, couldn't make it, and it pulled away from it. What is the most immediate number, psychological number that comes to mind? How about 5,000? SPX 5,000. We're gonna see a reaction in or around that number. I think if we go down tomorrow in a gap down or a flush down right off the gate in the morning, and we get to 5,000, again, I'll be inclined to buy some calls betting on a rebound, intraday rebound, because it could be Powell, it could be whatever. That could cause a rebound and buying at the 5,000 line. I don't think it's sustainable, but it's going to produce a reaction. On the SPX weekly chart, what do we see here? We've been talking about the MACD indicator. Once you see the red columns in the histogram, the change in momentum, as we've seen back in the summer of last year, you know that the market is ready for a correction. But again, 5,000 will be important support. If we lose it, I think we accelerate the downside, but we might get a reaction before we do that. If you look at the E-mini futures, piling the evidence here, folks, what was the bull to bear line? 5,257.25. Look what happened. The last coverage that we've done is the bear flag, and I'm leaving all of the marking as it is. I was predicting a rebound, then we come back. Boy, did we rebound Thursday. And we came back exactly as we predicted, but the rebound was much, much higher than what I anticipated. But it got us to the bull-bear line. 5,257.25. It was a clear rejection that we lost 5,218. What more would you like to see to take the shot? Anyhow, now we're oversold in the hourly chart. We have support in or around 5,092.5. Would not be surprised if this support is kept overnight and we see a rebound tomorrow. The Qs in hourly chart, what do we see here? Again, big flush down, gave us the fake rebound by Apple on Thursday, caught a lot of people off guard, then they gap it down nasty action. And today they give you a gap higher, they flush you down again, and it was a nasty flush that caused the hourly chart to be really, really oversold. Now, can it go further down? Sure, but any gap down tomorrow, I would see that as an opportunity to play a rebound. If we gap higher, though, in the morning, not sure that I'm going to play a rebound. I'll probably again fade the rip. So say if we go to 433.71, 435 in the morning, I'll probably be inclined to fade the rip here. If we look at the Qs, same story. This is the SPY daily chart, the bear flag, the drop down, breaking the 50. So what is the next support? How about filling the gap at around 425.70? The NDX, the NASDAQ 100 weekly chart, what do we see here? We've been talking about the loss of momentum in the MACD. Got a confirmation. Now we're beginning to lose momentum. I have my support at 16,600. And if that fails, we still have the trend line. And the chart doesn't become bearish until we lose the trend line. Because at that point, we no longer have a bullish trend line of higher highs and higher lows. If we look at the NASDAQ futures, did we get confirmation of the loss of trend? Yes. How did we get that? The loss of 18,181.5. It happened before. We needed another confirmation. Now we got it. Translation, you'll get rebounds. Sure, hourly charts will become oversold to get rebounds. But for now, since we've broken trend, the rebounds are to be faded. The IWM, small caps, and again, I'm leaving the drawings that we've done in the last video as it is, and this one was spot on. We were talking about an inverse ABC pattern. So we got the B leg and then came the C leg with a nasty flush, closing below 196. But you look at the MACD, look at the RSI and the hourly, oversold, sure. Can we get a rebound? Absolutely. But you look at the daily chart. Do we see significant damage when you're expanding the lower Bollinger Bands like this? Of course. It means the chart wants to push its way to the downside. What would that destination be? We'll look at the weekly chart. We lost the 20 weeks moving average. In the MACD, the momentum is turning bearish. In the Vortex indicator, we're about to get confirmation. You see the red line crossing above the blue. That's the bearish momentum overcoming the bullish. If we go down, we have the lower Bollinger Bands on the weekly chart, 188. You look at the dollar expanding the Bollinger Bands higher, the opposite of the IWM. That's bullish behavior, but it has resistance coming at 106, 613 basis points. What is the significance of the dollar if it's moving higher but not impacting metals? Maybe it is impacting the equities market, so think about that. But when it comes to the old man, he's not bothered. He keeps going higher. Not my favorite to chase, though. But if you must chase, you go with the GLD, the commodity, you don't go with the GDX gold miners. And the reason is, if there's a sell-off in equities, they're going to sell the gold miners too. When they sell the ETFs, they sell everything with it. We go back to the Tony Robbins conversation. Oh, pick the value stocks, the good stocks, avoid the AI mania. It doesn't matter. They sell the ETFs, they hammer all stocks, including the gold miners. Maybe the SLV could be another choice on the daily chart. We have some resistance at the top of the bearish engulfing candle, so I'm not a fan of the SLV here. I think it might be topping and it might head down. I like energy a little more than gold and silver right now. You see the rebound in UK oil, the Brent oil, above 89.61. Yes, momentum is topping. It needs to flare up in geopolitics to keep that momentum. Otherwise, it will do a correction. But I'm betting on that flare up to happen. So I'd rather be with oil than gold and silver right now. What you don't want to do, as we've said with GLD and GDX, you're going to go with the commodity, not the gold miners. It's the same thing with oil. You go with the commodities such as USO, but the XLE you avoid. XLE energy stocks, you can see the drop that we got today, retesting the 20 daily moving average. Momentum is turning bearish because when they liquidate everything. So right now, the commodities trump individual stocks. The 10-year yield daily chart, what do we see here? Continues to go higher. We have a bull flag playing out, so there's no stop. We're above, comfortably above 4.5. That's the number that we've been talking about, that if we pass above, it's going to rattle the market. And that's exactly what we got. We see more of that coming because the weekly chart, if you look at the hour side, the MACD, all becoming positive, expanding the upper Bollinger Bands higher, but not overbought by any means. So I think that we go back to the highs and even beat the highs from 23. That's going to rattle Powell, rattle the market, and change a lot of assumptions. XHB Home Builders daily chart, what do we see here? We talked about the bearish engulfing candle followed by a bear flag pattern, lost the 20 again. That's a confirmation for more downside, but we have supported the lower Bollinger Bands. So we have to look at the weekly chart. And the next support we have is the 20 weekly moving average in or around 99, 94, let's call it 100. but you see the momentum being lost. In the MACD, it's changing from bullish to bearish. Same thing goes in the RSI with a negative divergence. What about the IYR real estate? Now, congratulations to the traders who stuck to the trade, did not close it like I did. I mean, I walked away with a profit, but it was the 87 puts with the expiration date April 19th. But boy, today you should have booked profits. We talked about this with a lot of traders in Discord, or in this trade. With the volatility moving higher and getting a flush like this, you gotta book profits because you're booking profits at maximum gains. Any rebound from here, any drop in the VIX, you're gonna lose a lot of those gains. And now we see in the hourly chart perhaps a falling wedge pattern and the potential for a rebound. On the daily though, we lost all support. We lost even the 200 days moving average in blue, so we have to look at the weekly chart. Okay, here we lost the 20 weeks moving average. Momentum keeps getting worse and worse. In the weekly chart, there is a potential that we go down if the 10-year goes back to the top of 23. IYR goes down to the bottom in October and retests that bottom. It is rational, but not for the expiration date of this Friday. Let's do the KRE. And if you look at the hourly chart for regional banks, again, gap and crap, we see the weakness here, but there is still the insistence by managers to buy the regional banks because they're betting on, oh, the Fed is going to fix anything. Any problem with the regional banks, Fed is going to plug it. Well, good luck with that assumption. But right now, looking at the charts, can we argue for a falling wedge pattern, rebound in the KRE? Sure. But in the long run, you don't want to be in the KRE with yields going higher. It's going to cause a problem in regional banks. We'll see major flush downs. Then the Fed comes to the rescue. VIX daily chart. What was the trigger here? Because we predicted the breakout in volatility. What was it that gave us the assurance that it's going to happen? Head and shoulder pattern, but most importantly, retesting the 200 days moving average in blue and then rebounding after that. That gives you the confidence that the VIX is going higher. Or importantly, with the weekly chart, we talked about this numerous times before. The moment we see a weekly closing above the 20 weeks moving average, understand that volatility is going higher. And this is what we see right now. And you don't see that on the weekly chart, the RSI or the MACD becoming overbought. So we can go all the way to 2308, the previous top, and then face some resistance. And maybe that's going to coincide with SPX 5000. See a rebound in the SPX and a pullback in the VIX. Big Cajon Apple, what do we see here in the hourly chart? Bear flag pattern. You see the momentum in the hourly chart and the MACD changing from bullish to bearish. Today we talked about this in the morning brief. Maybe we have a topping head and shoulder in the continuous chart. If we lose 173, I think it goes down and it plays the head and shoulder pattern. And indeed, we closed below 173.5. So I think that we could see Apple erasing the entirety of the pump from Thursday. You look at the daily chart. How do you confirm that? In blue, the 50 days moving average, you see the rejection. If we lose and close below the 20 in white, confirmation that down we go. If we look at Tesla, we talked about this in the morning brief. You got an inverse head and shoulder pattern within a larger head and shoulder pattern, with the critical line being 170.60. Now, had we traded above 170.60, I would have bought calls on Tesla. I told you that in the morning brief. But since we flushed down right off the gate and we did not trade above 170.60, there was no trade. But can we see a rebound tomorrow? Sure. You got a falling wedge pattern. We could see a rebound tomorrow, absolutely, in the hourly chart. But on the daily chart, the weakness is becoming evident. So you have the last line of defense, 160.5. You lose that, you got a problem. You look at the MACD indicator now, about to change from bullish to bearish. So if you see that confirmation, the loss of 160.5, and then the loss of the MACD indicator changing from bullish to bearish, you got to take the shot and bet against Tesla. How about NVIDIA, an hourly chart? What do we see here? Gap and crap in a big way, and we went down to 860, a critical line, but never closed below. Can we see a rebound in NVIDIA tomorrow? Sure, but the weakness is becoming evident even in the most important name in the stock market right now. Look at the daily chart. We see a series of lower highs and lower lows. And today was a retest of the 20 in white, and we lost it. So you add it all together, I think that NVIDIA heads further down. We look at Bitcoin Tulip's daily chart. What do we see here? We talked about maybe the possibility of a false breakout outside of the upper triangular consolidation pattern. You have to watch the MACD as a confirmation. Did we cross from bearish to bullish to confirm the breakout? Absolutely not. This is how we knew it's going to be a false breakout. Now the real breakout comes to the downside. And if you plug the Bollinger Bands, we lost the 20 days moving average. We're consolidating in a bear flag pattern. Who's to say we're not going to go down to 59,224 and seek support down there? You look at Coinbase, topping in a shoulder, big flush down today. We just need one more flush down tomorrow. We close the trade, preferably if we go down to 205.77, close the trade, book profits, and we'll move on for now. MicroStrategy, same thing. If you got a short like I do, my profit-taking target would be $11.99. If we go down there, I'll close it and then reassess whether I should be holding or not. Robinhood is another crypto proxy, Bitcoin proxy. We see the same pattern, topping in his shoulder, It broke 1770. If you have the 17 puts, as we talked about before in Discord, you got to keep holding on those because we lost the 20. Next support I see is the 50 at 16.21, the line in blue. And lastly, Mara, the miners. The halving event is going on this month, and we see the double top in the daily chart. Now it's expanding the Bollinger Bands to the downside, getting really weak. I think we find support at around closing the gap 1352. If we lose it, then we got a big problem. But my anticipation is we find support at that level. Okay, let's move on and wrap up this video. What do we have on the economic calendar tomorrow? Interesting session because we have housing starts and building permits, important data for the housing market. Then we have industrial production and capacity utilization. But the most important event will be Jerome Powell speaking, the big zombie, and he might hold the key to rebound the market if he's successful in talking rates down. And that's a big possibility for tomorrow. So all eyes will be on Powell. But folks, let's just wrap it up right here. Thank you for being patient. Thank you for being supportive. And I always have to say that I love you all, appreciate you all. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
But like every one of the superstates that preceded it, it has one iron rule. Logic is an enemy and truth is a menace.